chose for yourself, that vision that you created for yourself, put a one in the chat for me and congratulate everybody else that is on this call. Because today we're going back to the basics. We talk about money and property and ARVs and all these things all the time. We talk about where you should look for property, zip codes, duplexes, single families, all of those things. But guess what? None of those things happen if you don't have your money right. And if your loan is not structured correctly, you could possibly go into the deal wrong. And what do we always tell you? You make your money going into the deal, not your exit strategy. Your exit strategy is the extra, it's the benefit, it's the way off the freeway. But you have to know where you're going before you jump on it. So today, we are bringing back a super veteran, somebody that had possibly one of my favorite DSCR loan processes that I've ever done. We have the world famous Mr. Patric Amar joining the group today. Patrick, jump on and tell the people about yourself and what we doing.
Happy Saturday, everybody. I am very happy and glad to be back with the Win Blueprint team. I used to, a little bit about me, just a quick little background. I used to work for a private lender by the name of RCN Capital. And when I was there, Eric was my first closed deal. And we worked so well together. And then he introduced me to Chuck and Michael. And then eventually I became part of the team as one of the DSCR lenders. I came out to the boots on the ground in Cleveland a couple of years back, and I just have to say, I said this before, I stand on this business on it, but what they got going on is absolutely insane. It's something that is not really pushed out a lot, and it's something that, everybody is very blessed to be a part of. So I am here to provide value. I'm here to answer any questions. Lean on me. I I'm a straight shooter. I may be a loan officer, quote unquote, but I don't like to hard sell. So if the deal makes sense, that's something that we look at. I don't want you guys to think that, I'm here just to take you guys from anybody's current business. What I'm here for is just providing value, being an extra hand to reach out to and be like, hey, I need some help, whether it's on the fix and flip side, whether it's on the DSCR side, whether it's just calling me as, hey, I'm looking at this deal, this is what's going on, and you guys want to talk about it. Like, I'm more than happy to just run through it. I know Eric and the team, Eric, Chuck, Michael, they've built such a great foundation, and my sole purpose is to just stay a part of the team, have that value add continue to be poured into you guys, and also, like I said, lean on me for anything. If you guys have any questions, if you guys want to call me and just tell me how your day was, I'm completely okay with that. I'm as cool as a cucumber, I guess is what they say, right? But thank you guys for having me on. I'm not going to ramble too much. I would like to hear from some of you guys, within the next few minutes here on what challenges you guys are coming across, so we can talk through them as a team, as a family, and let's kind of go going from there.
Awesome, awesome. So I guess we can jump straight into more of a Q&A session. Um, I think the first things we should start with is the new company that you're with and the types of entry points that you can offer. Will it be private money, hard money? Will it be more traditional loans going in? What do you think is going to be your strong point for our mentees?
Yeah, so I want to say we're well-rounded. Ternus is a company of investors. So our CEO, his name is Tim Harridge. He used to be the executive director at RCN Capital, and he would, connect me with a bunch of direct borrowers because we worked with brokers and whatnot. But we would, connect me with a bunch of direct borrowers, and he's a very big fan of, if I cannot lend the money that I would borrow, then I don't want to start a lending company. So Ternus stands for the 3 points. It's not to go too deep into what Ternus means and what's going on, but where we are really winning is on the new investors up to 100% financing. And I'm only wording it that way just because it's all deal specific, realistically. And I'm sorry if you guys are hearing background noise. We had a flood in my house, and I'm currently doing renovations downstairs. So today's the day everybody decided to grab a hammer and start swinging. But just a heads up. So uh, where we can kind of get in the process is like when I said I can be an extra source of capital, it's on the fix and flip side, it's on the DSCR side. If anybody wants to do any portfolios, we can do that as well. Very similar to how RCN would work. And I don't know if anybody has worked with RCN here prior, but basically DSCR loans, we all know what that is, right? Um, the exit is, and I'll touch on this. I have a couple slides as like pinpoints. Maybe I can share my screen at some point whenever we get into the presentation. But to keep it as simple as possible, 1 to 4 family, fix and flip, up to 100% purchase, 100% rehab. Um, let's say up to 70% of the total loan to cost, which is, I'm sorry, 100% total loan to cost, up to 70% of your ARV for a maximum loan amount. And I'll go into those details later. But that's just an option. We have other programs as well. And, we can get into that more on the fix and flip side. Um, when it comes down to DSCR, we're going to be very aggressive with DSCR in pertaining rates and type of fees type of thing. It's a little bit different on my end now. I used to be able to come to everybody with a 0 points in origination. Everybody loves to hear that. I know. Let me start seeing some smiles for 0 points. Yep. So now it's going to be a little bit different. The DSCR market is a little bit more lucrative, I want to say, in certain aspects for certain lenders. Now, some lenders may still come in and offer that 0 points in origination, but the rate may be higher because a lender's got to make their money somehow, some way, right? But like I said, I'm not here to upsell. I'm not here to do anything where it's going to be, uncomfortable for you guys. Something where I'm taking more money out of your guys' pocket because that's not the end goal. And long and short of it is, I'm looking to join the Win Blueprint as an investor myself. So you guys will have full access to me, and hopefully I can come out to the next boots on the ground. I gotta light some fire under my team so that way they can get me out there. But that's basically what Ternus is about. I want to be able to see what other questions you guys have as first time investors or maybe some seasoned investors on what you're seeing and what maybe I can help provide value on. But one of the key pointers that I'll get into a little bit deeper later is we all want to win on each deal, right? And even if it means that we cannot recoup a lot of and I'll say it like this: if we cannot recoup a lot of the cash back on a cash out refinance, your end goal is to own assets, right? Your end goal is to own an investment property that's cash flowing, because then it's just stacking on there and we're building that. And everybody has told me, or people have told me here and there, oh, I asked them, why do you want to be an investor? And they say, I want to build generational wealth. I want to build a portfolio. And then, come down to like a deal that they may have stretched very thin on and they cannot get much cash out on it. And they're just like lighting me up at this point. And I'm just like, hey, I can, it's not my fault. I'll be your punching bag, no problem. But I'm also going to coach you through it. I don't want you guys to, think that, hey, if we cannot reach a certain number on a cash out, that it's all, it's the end of the world and it's just not going to work out. So if your goal is to continue to build assets, to build a portfolio and have your portfolio continue to grow, you're in the right spot. It's okay that we don't get a cash out refinance and maybe go to a rate and term refinance, because now you're holding an asset and you're banking on appreciation. Where if you're buying within that same market, Eric's very notorious for this. I know Chuck and Michael do the same exact thing. But if you're buying the same market, you're controlling the market. You're controlling what your appraisals are coming back at, right? So that's like a big thing. And I'll touch more on that later. And if you guys have more questions on it, maybe write them down or something, or put them in the chat, and I'll go through them a little more towards the end. But what are you guys seeing as investors? And if you have any questions, let me know. Are you a new investor? Are you looking for what's your goal? What's your exit strategy? What's your end goal for everything?
Super huge open-ended question. We have We have people that are at various stages of their investing career. I think, for the sake of time, and Eric and Michael, feel free to correct me. Let's do the presentation slides now, and that way we'll have time for the Q&A. And then if we have questions in real time about the slides, we'll jump in. Eric, is Patrick able to share a screen?
Yep. My screen.
Okay.
Here we go. All righty. So can you guys all see my screen?
It's coming up.
All right. Move this here, down here. All right. So Ternus, like I said, built wealth with a lender who gets the deal. This is the motto of Ternus because, like I said, Tim Herridge, if you guys want to look him up, he's a very well seasoned investor himself. He's built majority of Dallas, Fort Worth area. Him and his partners. He started B2R with BlackRock or one of those. Not too familiar with the details, so please forgive me. But yes, he's an investor himself that wants to make sure that other investors, wherever the challenges we're getting with these bigger companies, Kiavi, Lima One, Lending One, RCN Capital, that us as investors cannot have a full grasp on, is where we kind of come into play. Hence, fast closing, quicker appraisals, or we call them valuations, and faster closing times. So typically, I mean, we've been averaging about a 7 to 10 business day closing. That's really, and I'll go into more depth on that. But this is who Ternus is. This is like a little playbook. A few things that I always like to touch on in the beginning is, number one, buy right. You want to make sure that you're as knowledgeable as possible, but also have yourself be okay with the possible, the worst outcomes possible. And what I mean by that is, let's just say we are, sorry, let me move this here. Let's just say we are looking for the right the right property, right? You're looking between 2 to 3 properties, and which one is the right one. It's always good to work backwards. Now, working backwards as a lender versus working backwards as an investor has the same benefit, because at the end, we're meeting in the middle. And what that means is, like, okay, if I'm telling you you can go up to 70% of your after repair value, you know that 70% times your after repair value is going to be your maximum loan amount. You then back out what you would essentially purchase the house for, which is where your rehab needs to be, right? Where you should be consistently with your rehab on, not consistently, but where you should be with a rehab on that property specifically, because then that'll kind of give you more of an idea to speak with the contractors or to know what exactly you want to put in the house. One thing I always like to point out and everybody keep in mind is, this is a game of Monopoly in real life, right? You don't want to take a small shack in an area of, nice single family homes, about 1,600 square feet. And this little small shack, you want to take it and blow it up into a 2,500 square foot property. We call that the unicorn of the neighborhood. And that's, if we want to do something like that and we're trying to achieve a higher ARV, honestly, it's not going to work out. It's not buying right. Your main goal, and it also works the other way around, right? So if you're taking 70% of your ARV and you're backing out, how much rehab you really want to do. So typically you guys are doing like standard rehab, standard cabinets, LVPs, paint. Your houses are not supposed to, but realistically should be looking the same. So you know what your total construction cost is, right? Now, in a case like that, let's just say your construction cost is, let's use numbers for, easy numbers for this example. But if your ARV is $100,000 in an area, and I can lend you up to 70%, then you know that your maximum loan amount is $70,000. Now, if that property is for sale for $50,000 and you can negotiate that down $10,000, you're now adding $10,000 to your rehab budget that you can use to add that value, where your minimum ARV should be $100,000. So it's really kind of just being strategic. It's really knowing the area, having the comps, making sure your comps are very comparable. And I like to emphasize on this, you guys, because when you have the same square foot, the same bed and bath, and a property that looks similar to what you want to or what you can upgrade this investment to, we're going to have a better time and an easier process, frankly, just by getting the deal, putting the work into it, and making sure that we're targeting the numbers that we need to target. Because think of it like this, you guys. We have a third party appraiser or a third party inspector that has no idea what you guys are thinking, that is only relying on your rehab budget and a purchase contract, because they're looking at two things like this and they're like, okay, they're purchasing it for X, they're putting Y into it, and it's going to equal Z. So help me understand how purchasing it for 20,000 and putting 50,000 into it is going to get you to 100,000 when your total cost is like 70,000, right? So we really have to be cautious of what we're doing in our rehab budgets. And I know this may fall, a lot of us may think that it falls on the contractor, but it really doesn't. It falls on the both of us as investors and the contractor, because what ends up happening is like, okay, let's just say the contractor is coming in and is like giving you a rehab budget that he knows what he's going to do. You know what's going to happen, but then you're sending it to me and I'm like, okay, well, this doesn't make sense. You're just going to remodel a bathroom. Like, what are you going to do in it? You know, you want to be somewhat detailed because, again, you guys have to paint the picture. As investors, we want to paint the picture to the appraiser, to the inspector, to the desktop appraiser, to anybody that's going to be looking at this and seeing, hey, you know, we are going to add this value into this home, and it's really going to be worth this number up here that we're targeting, you know? So that's one of the big things. That's buying right, that's finance the plan, recycle your capital, just it's plain and simple. You want to take your money that you put into this property, you want to build the equity, you want to build value, add what you can to make sure that you have now a lot of equity where you can take that equity out on a cash out refinance and turn around and dump it into another project. So it's just kind of stacking on that point. Do we have any questions? If you do, I can't really see much, guys, so I'm sorry, but just put it in the chat. It'll pop up for me. But I'm going to just...
I got one, Patrick, really fast. 7 to 10 day closing, is that applicable to DSCR loans?
No, that's only on the fix and flip side. DSCR loans, and let me touch on that a little bit. Great question, Eric. 7 to 10 days is with a valuation from a company called Richer Values. Now, full transparency, Richer Values, if we're not fully detailed with our rehab budgets, and this is only on the fix and flip, on the rehab portion loan, right? DSCR is going to be a full appraisal. So it's going to take about a week to a week and a half for the appraisal to go through. But it's not something where... Do you guys hear that pounding? Or is it like distracting? If it is, I can move.
I think we're fine.
Yeah, okay. So DSCR is really going to take a full week to a week and a half for the appraisal to come in. And then and me, you know, us working together, I like to structure it a certain way where Eric, Chuck, and Michael know this, but by the time the appraisal comes back and we have the appraisal, I need all documents from us in, because once the appraisal comes back, I can speed the process up and I can kick that file into underwriting. We'll confirm terms, we'll kick it into underwriting, figure about 3 to 4 weeks for DSCR. That is just an estimated time. Now, of course, we can always put the appraisal on a rush, but it's extra money, and I will never tell you guys to do that unless it's necessary. For the fix and flip 7 to 10 days, that's ordering a valuation and keeping our ARVs at a 70% cap as of the max ARV. That's ordered with a Richer Values valuation. And again, if we don't paint that picture in that rehab budget very, very well with that, or for the desktop appraiser to see where the ARVs are coming in, they're going to come in low. We're not going to be happy, and then we're out $500-600. And then, you know, if you want to order a new appraisal, that's another $600 to $800 there. So it's not worth it. I do not advise to, you know, I do not advise to miss on the beginning parts of things, right? Meaning make sure that your rehab budget's detailed. Now, the Richer Values report comes back within 3 days, 4 days, give or take. And by that time, we should have all of our documents in with processing so we can just kick the loan into underwriting. That's where we reach our 7 to 10 day closing time. There is a lot of back and forth with our team internally right now, and we're working on a better process for some things. But draws are going to be. I'm sorry. The loans themselves, they're full Dutch interest loans. So you know what? I'm sorry. Give me 1 second. Let me pause. I gotta move to a place.
So, Patrick, just so you know, we can't hear the background noise. I know it's probably
You
throwing you
can.
off, but we cannot hear, at least
Okay,
on our
that's
end.
good.
We're good. So it's not throwing up.
My room sits right above the kitchen, so
No worries. Completely
yeah.
understand.
Okay.
Um,
Actually, this is
Eric
better
did
for me.
have a message in the chat. He said he had a lender ask us for an appraiser of choice. Is that something you guys do, or do you guys order the appraisal from a third party company?
Oh. Appraisals are going to always be ordered from the third party appraisals. They have to be
Okay.
part of the AMC. But for DSCR purposes, if you guys have 5 appraisers that are good, that you've worked with, that will come in with good valuations or good numbers,
Hmm.
send them over my way. I can put an appraisal panel together for Cleveland or wherever, Birmingham or wherever you guys are going to be. And at that point, I can turn around and I can put that appraisal panel. So any appraisal order that I do for our group will go straight to this panel.
Nice.
So this panel let's just say 5 appraisers, they'll all bid on it. Whoever gets the best bid will take it and we'll move forward with it.
Awesome. Awesome. Okay. Sorry, didn't want to distract you too much from the slide, but I know you were repositioning, and then
No, you're
Eric
good,
had that
man.
question in the chat. So feel free to pick back up.
All right. So, oops. Okay. Cleveland is affordable, but it's not the uniform market. This is just a bunch of things that the team likes to put together.
Sure.
I think Cleveland is a great area. I think that it's Ohio is one of my favorite states to invest in. I have guys that are out in the Dayton area, Cincinnati area, Columbus area. It's Cleveland. Cleveland is just a growing market, and a lot of investors are touching it because you can get a property for sub 100K. You can put 20 to 30,000 into it, and it can be conforming, right?
Mhm.
Um, so Cleveland City median sell price, and this is all pulled off of Realtor.com, I believe. It's not the all end all, but this is just stuff when we're putting the median sale price in here. That's kind of like a target of like median sale price, across all of Cleveland. This is where it's at. East Cleveland, I don't know how it's looking now, to be honest. I don't know if this number is accurate, but I'm not going to go too deep into this. I know the markets that you guys are in. Have you guys changed markets yet, Chuck? Or are you guys still in the same areas like where we went that one time I came out?
No, we definitely have opened up the zip codes. There's
Nice.
actually a handful more in the area, so we've definitely expanded the footprint.
Very nice. Okay, cool. That's good because I know that a lot of times, investors are going in there and just it can get to be a flooded market and then deals are just hard to get. So it's
Right.
really good that we're, expanding that. Um, we do lend in 39 states, mostly Midwest and East Coast. Nothing on the West Coast. Nobody likes to touch California. They're more of a tenant-backed state versus a landlord-backed state, and we don't like
Hmm.
that. As a lender, as an investor, as somebody living in Los Angeles, I want to bang my head against the wall every time I think about starting my car. And I drive a Prius, guys, so like think about that. That shit's expensive. But we want to be in like the C plus to B workforce neighborhoods. You know, rehab, light to moderate rehab. It doesn't have to be lipstick where you guys are just going in and painting, right? Like I said, LVPs, bathrooms, kitchens, um, uh, painting the house. If you guys want to do bigger projects because it can be conforming, great. I don't recommend it, especially as a new investor, because it's not the contractor that I'm really essentially worried about, knowing the contractors that the team has. I think it's more of biting more than you can chew as an investor, right? You want to go in, you want to be in and out quick, because that's how you're going to build your wealth. Um, California, sorry, Henry. California, Arizona, Nevada. Arizona, we're actually getting our licensing in, so that should be coming in soon. Oregon, North Dakota, South Dakota, and Vermont. Those are the few states off the top of my head. And I'll drop a map of, actually I think I have it somewhere here. But I'll show you guys in just a bit on the map of where exactly we don't lend. But if you have a specific market that you want to be in, and I do not lend in it, again, like I said, lean on me. I'm more than happy to help. I can refer you back to my old manager at RCN, that they do lend in like 48 of whatever, how many states, 50, 52 states, whatever. But I'm here to help. So don't think, like I said, guys, I don't want to be here and just be like, oh, I'm a lender. This is what I do. Eric, Michael, Chuck, and I have a great relationship. I look at them as family. So anybody that they are working with is now family to me. That's just how I work. So, like I said, if it's something that I cannot do, I'll guide you guys in the right way. So don't worry about that. Let's All right. Burst strategy. Everybody knows what the burst strategy is, right? That's what makes us financially free, wealthy, whatever term you want to use for it. It's what makes us as investors who we are. You want to buy below market basis. You want to do your rehab, make sure you're adding value. You want to rent it. Then you want to refinance it. Now, you can refinance before you rent it coming out of rehab. That is okay. But you don't want to go into a property and hold a 30-year note without having your tenants pay for your mortgage. I'll leave it at that, because that's just as simple as I can make it. And then obviously you want to recycle your capital, so it's just a rinse and repeat after that, right? It's something of, when you're buying to have when you're buying an asset, you want to make sure you have two exit strategies in the back of your head. You want to have, I want to hold this property, and oh shit, I can't hold this property because I'm in over my head. And it's okay. As an investor, tough pills need to be swallowed fast. And when tough pills are swallowed fast, you are able to hit a roadblock, take a step back, and be like, all right, this is how we're going to handle it. Now you have a backup plan, a backup strategy, right? I think that I've run into a lot of first time investors outside of the group. But over my 5 years of lending, I've ran into a few investors that were like, I must hold this, or I don't want to hold anything. I just want to build capital. Great. Go pay capital gains or put it in a 1031 exchange and dump it into the next property. But now, how are you going to scale? You can scale for sure, but have your exit strategy in place. Know exactly what you guys want to do. If you have plan A and plan B, and plan A falls out or plan B falls out, you have something to lean back on. These are assets, you guys. They're property. Property, if it drops, it'll drop. I mean, unless you're in California, Los Angeles area, and it drops drastically, and you're just like, oh, I'm in over my head on $1 million house that's now worth $600,000-700,000. That's where the issue is. But in the markets that you're in, it's a workforce market, right? It's a lot of people that can't afford to buy their own homes, or can't afford their own homes, so they have to resort to renting. It's all a lot of blue collar, a lot of families, a lot of Section 8s, a lot of HAP. HAP is another thing of Section 8. These are agreements that we can get from the government that make sure that every first of the month we get paid, right? And are you guys still doing Section 8 stuff? Yeah, that's
Absolutely.
good. Yeah, I was going to say, make sure to stick into that. A few things that I will say lenders do not like at all are daycares, assisted living, rehab facilities, anything that, think of it like this. Any, worship places. Like I had a guy ask me if, a guy in Detroit calls me and he's like, "Hey, my partner in Israel wants to buy this, 5 unit property and house a bunch of like, mercenary or whatever they're called from Israel." And I'm like, "That's great. Have good luck. I can't do it because and here's how I explain it. If I have to foreclose as a lender, I don't want to foreclose on children in a daycare. I don't want to foreclose on grandma and grandpa in an assisted living facility. I don't want to foreclose on people that are in a rehab facility that need help. The simplicity of it is a family, Section 8, people that have vouchers, stuff that can, if you cannot and you have to evict or you have to, if the lender's foreclosing and they have to kick somebody out, it's not gonna, somebody can go get. We can't foreclose on God, like that's just gonna be tough for us. Um, but that's something that I always like to say. You
Definitely
say
bad karma.
40K to 80K purchase. Is that how much you lend, or are you saying actual purchase prices over 80K you do not take? Great question, Monica. My lowest loan amount I can do is 50,000. My highest loan amount on the 100% product, I can go up to 500,000. I'm not limited to 500,000 though. When you're purchasing a property, if you were to purchase it at $20,000 and you add 30,000 in rehab, I could still do the loan because you're at 50K. If it drops below 50K, that's when we'll have, a little bit of a stopper there for us, but not I wouldn't focus too much on just the numbers that I have on here. This is just example basis. So for us as Ternus, as if I'm gonna lend you anything, I'm okay to lend as low as $50,000 total loan amount and as much as $500,000 maximum loan amount on a 100% program. And then I can go over 100,000, 500,000 with another fix and flip program where it's 10, 15, 20% down. Sometimes it might be 30% down, but great question though, because I know that I was thinking that as I was putting numbers in here, I was like, oh, I hope it doesn't confuse anybody, but great question. Um, all right. 5 gates to determine whether a property is financeable and investable. Now, I know you guys have your, like Chuck, Eric, and Michael have their systems, right? If you're asking me as a lender, I'm going to tell you, you want to make sure that you size the loan first. You want to make sure that you understand how much it is. You want to understand what the comps are in the area. You also want to understand where we may lose, right? Not that we want to, but when I say where we lose is like, okay, if I reach out to this lender may deny it because of area, because of, you know, no, not good credit or whatever. There's a bunch of things, a lot of factors that come into play. But our goal is to win on this, and how we're going to win on this is to have a trusted source, such as the coaches in here, such as myself as a lender, but also, a friend, where I can lend the handout and say, hey guys, I don't think this is something that I would do. Like when I'm writing loans, guys, I don't sit here and write loans like, oh, the numbers say so. I look at it as if I'm going to lend my own money, right? And I think you guys looking at it like that as investors is, okay, I'm going to buy this property. What would I lend my own money on? And when you're speaking to any lender, whether it's myself or Neil or whoever else you guys are speaking to, that's how every lender is going to look at it. Would I lend my own money? Now, if they're just writing loans and want to get the loan closed, I say this very lightly, but run the other way or seek help, because that's not somebody that's working in your best interest. And we don't want that. Valuations with richer values, like I said, it's just forefronting the rehab budget, making sure it's detailed, making sure it's understandable of what we're trying to do, how much value we're trying to add, and what comps in the area that support the number of the ARV number that you're targeting we're going to compare to. What we're adding as investors to compare to this ARV. Construction, you guys have a great contractor book. I have nothing to say about that. I don't think I don't think I can say anything else about that. Now, if you guys do want to go into different markets that you don't have the contractors out there, we do partner with a company called OfferPad, who's a contracting company that they work in, like, for example, if you guys wanted to go from Columbus to Cincinnati and don't have any contractors out there, number one, I can get you guys connected, no problem, with some contractors. But I also, and I'll be at a conference on Monday. I'm actually going to San Diego tomorrow for this conference on Monday called Investor Fuel, and OfferPad's going to be there. So I'll get something from them and I'll circulate it to Eric, Chuck, and Michael, so that way you guys can all have it. That way, if you wanted to go to certain markets and didn't want to go through the vetting process of contractors or deal with any headaches of contractors, you have an exit avenue, which is OfferPad. We give them the draws. We save you guys on draw fees. We save you guys on draws in general. That's something that, down the line, I just wanted to put that out there, as if anybody wanted to move to a different place. Of course, I would just, I would actually run it with Chuck, Eric, or Michael first, whoever your coach is, just to make sure. And then I'll send you guys this OfferPad thing, so that way, if it does make sense for, the Win Blueprint to kind of have that as another contractor source in different areas, by all means, use it. It's something that's really good. Rental, market rent, voucher rent, taxes and insurance. We all know what PITI is, right? If you have anything, obviously our DSCR is debt service coverage ratio, means we want the rent to cover the mortgage plus put some money in our pocket. Call that cash flow. Exit strategy, I kind of touched on that. So, you either want a DSCR, hold it, or you want to sell it. Now, if you want to do something else with it, we can talk about it. I can help with, some other things, but it's all going to be about structure. So, and I say this very lightly, if we're going to do something where we, as a lender, may not be able to lend, let me help you, guide you on how we can structure that, so that way you can be successful with it. But from there, we just got to continue building. They gave me this little example, right? Total basis on a $60,000 purchase with 25,000 rehab is 85,000. Your illustrative ARV is 145. In an example like this, I mean, let's do the numbers backwards, right? So if we're doing 145, here's my stuff. Can you guys see my calculator, or is it just the
No,
screen?
it's just a slide currently.
All right, perfect. I don't
But
want
feel
mess
free
up
to
on this.
deconstruct. We can walk through it.
Okay, so if you guys want to walk through this with me, let's just say your ARV, we're targeting 145,000, right? So we're going to do 145,000. We're going to multiply that by 0.7 or 70%. That gives us a total loan of 101,500, right? Your purchase is 60,000. Your rehab is 25,000. So on your calculators, if you're doing it on that, take 101,500, subtract $60,000 as your purchase, you come up with 41,500. You can do rehab up to 41,500 and still get that 100% financing, is what this means, right? So you're not limited to $25,000 in rehab, because your cost basis, you guys, right here is only 85,000, where our maximum loan is 101,500. So that just tells us that our cost basis is, and our LTV is lower than that 70%, which also means if you wanted to put more in rehab, you can. You're not limited to 25,000, but this is the formula to get to it. So, and I'll put that in the chat where everybody can see it. So ARV times 70% equals oops, equals max loan amount. And then max loan amount minus purchase equals allowable rehab funds, rehab budget to go to. And then vice versa, max loan amount minus rehab equals what you should cap yourself to buy the property at. And I say that very lightly as well. Reason for that is because let's just say that you're buying a house and the house is more than, let's just say that you're trying to get the 100% financing to come with, as little to the table as possible, but you really want this house because there's good potential with it. Now, if we're constrained, all we're going to need to do is come to the table with the down payment. So it's kind of defeats the purpose of that, right? But if you guys have scenarios like that, my suggestion is like, let's talk about it, because I don't want you guys to have anything where you're like, oh, I can't do this because I can't achieve the down payment. Or Patrick said that, he'll be able to fund 100%, but now that we're running numbers, he can't really give me 100%. I have to come to the table with a down payment. But it's all about constraint, right? How constrained we're going to be.
Awesome. We are, just as a time check, we got about 6 or 7 minutes left, and then we got to do a little bit of housekeeping. Also, great time for questions, guys. Any questions about purchases, whether it's the entry, DSCR, loan amounts? This is a good time to talk about fees, all that good stuff as well.
Yeah. I covered the rest of this. I'm not going to even go through that. So what I'll do is I'll stop sharing my screen right now, and I kind of covered everything. But what questions do you guys have for me? What obstacles are you guys running into? How can I help?
I have a question.
Yes, sir.
We purchased a house in June. We get it rehabbed, let's say by September. It's 3 months down the road. We want to DSCR the loan, the hard money loan. Do we have to pay title fees and search fees and all that again? I mean, it's done 3
Yes.
years ago, so it seems like it's a unnecessary expense in such a short period of time.
So when you each loan, I'm going to try to say it the best way. Each loan, and because let's just say you went with a different lender, right? Let's just say you did the rehab with Neil. Neil may have pulled title. You guys may have done some stuff on that end. But when you come to a different lender, the different lender is going to need to pull title again, because as you're going to refinance it, it's going to be a little bit of a different structure for title. And think of it like this: when you're getting homeowners insurance for a rehab loan, you're getting a builder's risk policy. But when you're getting a DSCR refinance done and you need homeowners insurance, you need a renter's policy. So title insurance, and I could be, a little off on this, don't quote me on it, but how title insurance is going to work is they need to know if it's going to be a purchase or a refinance, number one. Number two, they need their title insurance to cover, to make sure that, God forbid, something happens. Title needs to be responsible for what may go wrong, tax liens or somebody suing or something of that nature, right? So title always needs to be ordered, because we need to make sure as a lender that everything needs to be updated per the title report, per the deed, that there's no liens or judgments or mechanic liens or anything like that. And if they do come about for whatever reason, because let's just say you're like, let's just say you're in an area where you're not using one of the preferred contractors, and this contractor decides to blow a fuse and goes and puts a mechanic lien on your property. At that point, if you go to refinance and we take the old title, we're going to look at it. We're not going to see anything, but when we run the new title, we're going to see that what's happening. We're going to see that there's a lien on there. We're going to see that there's a judgment against the property, not you specifically, but against the property. So think of the title report more as like a credit and background check for the property itself, as any lender would do a credit and background check on the guarantor themselves. So I will say that, and I'm sure your guys' title team is very good with pricing from what I remember, that they're not going to sit here and rip you guys on pricing. And what I mean by that is like, you're bringing in the purchase and the rehab, they're going to charge you X amount of dollars. You're bringing in the refinance, they're going to give you pretty decent rates. But to answer your question very simply, yes, title does need to be pulled on every property, on every transaction, unless something changes, I guess, per title requirements. But that's just how it's always been for any investment property. And one thing I do know is, like, I have my guys out in Dayton. They work with this title company, Partners Land and Trust or whatever. And they, on their purchase, they get very low title fees because they're getting hard money and gap funding and a bunch of stuff for themselves. But when it comes down to it, their title fees are like maybe $2,000 on the refinance, so it's pretty low. But title report is important. It's like a background report again to pull on the property versus like just trusting what the first one says, because anybody at any point in time can come and just smack a mechanic lien on there,
Absolutely.
right, and say that they've done work. So,
Yep.
but that's a great question, Henry.
Thanks for answering that. That cleared some things up for me, and it made sense.
Good. And if you have more questions, like if the coaches want to drop my information, you're more than welcome to reach out to me. Just ask one of the coaches. They'll give you my direct cell phone number. I don't like to give this group my work line because I like to build that relationship. So you'll have my direct cell phone number. You can call me anytime. I'm on the West Coast, but I work East Coast hours, and I'm just up all the time, so it doesn't really matter. What other questions do we have, or challenges, or what have you guys been running into? Tell me some things that you ran into, maybe that you can use a lender's perspective or the back end perspective.
Patrick, for Cleveland, did you answer my question about the appraiser?
Yeah, for DSCR.
Yeah, you did.
Yeah, we'll give me 5 appraisers. I'll put them on a panel for your team. Any order that goes to Cleveland will get sent to that panel.
So if I bring my personal appraiser, you guys will use that appraiser?
We have to run them through, I think it's class valuation. Remember,
Yeah.
we used to use Appraisal Nation,
Yeah.
ClassBot Appraisal Nation. But I'm able to call them and tell them, hey, give me 3 to 5 appraisers and I'll make it work. If they want 5, I can argue against it. If they come back and kick back to me that they need 5, have your appraiser give us a couple other people that he works with. They just have to we have to make sure that they are qualified under class valuation.
Right.
And if they're not, class will reach out to them and certify them under class valuation so we can add them to the panel.
If they want to get that done. Okay.
Yeah, exactly.
All right. Perfect. Thank you.
Absolutely. Michael, how you doing? We haven't talked in a long time.
Hey, Patrick. Hey, Patrick. I miss you.
I know, I miss you guys too. I'm gonna work to try to get out to Cleveland either probably like the end of the year whenever you guys go, or beginning of next year, just depending on everything.
Yeah.
So everybody can put a face to
You
the
were
name.
real fun on the last one. We had a good time with you.
Yeah.
So
I was also like single and doing my own thing then, and now I'm tied down, so I'm a little bit more calm. Let's put it that way.
No. But that's a good thing sometimes. Yes.
Yes.
So just important for everybody to run your numbers, win you later, flip you later. He pretty much said how we have calculators that, give them a max loan, offer number and all that stuff. But I would recommend calling, Patric every time you have a new deal and just
Mhm.
saying, hey, this is something I'm interested in. Here's the numbers. What do you think? And then he can give you the his quote on here's what your origination will be, here's what your points will be, here's what your percentages are, and then you can plug those into the calculators as well, because a lot of times we're just going off of Neil's numbers or Andrew's numbers, and we want to make sure that you can contact the lenders themselves, get their numbers and plug those back in and see if that deal works for you then. So that's why we teach you to do the flip you later, the win you later, and contact the lenders. And that way you have the full picture. So you're not going into it blind or having unexpected expenses that you didn't know were coming up.
Yep. Patric,
Yeah,
can
and
can
even
you
before
drop your
buying the
info?
deal, sorry, Eric, just to kind of put that out there, but before buying the deal, definitely give me a call. Like, run your numbers with everybody. That's my biggest suggestion: is run your numbers with whoever the options. Like I said, I'm not here to steal anybody's business. That's for damn sure. Like, it's not necessary to do that. It's providing you guys an extra avenue for financing. I will say I'm not cheap because we're fast money. Fast money is not cheap, blah, 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 blah. Right. But we can make it work. And what I mean by we can make it work is like, if we can get you 100% financing and close in 10 days on a fix and flip or on a rehab loan, why not? If that's what makes sense, great. If that's something that will work, perfect. Um, if it doesn't work out, I'm not mad. I'll tell you guys, hey, yeah, use that other lender. That other lender will benefit you. Definitely.
Yep. Patric, can you drop your information in the chat, please? Phone number
Absolutely.
and email information, I think is what Henry asked. And thank you for coming on, brother. We
Yeah,
appreciate
thank
you.
you.
I
Chuck.
had a question.
Thank you so much, Patric. We appreciate you.
Still have
Of
time,
course.
Patric.
Yes.
You mentioned earlier in the presentation that you do portfolios, and I'm assuming with portfolios, if we have two, three, four, I guess so many properties, you bundle them into one mortgage. Is that what that?
Correct.
Okay.
Correct.
So, my question then is, how few properties do you need to have to be able to start a portfolio process?
3 properties would be good. 3 properties, I would say, is the minimum. But the thing about portfolios, and this is a great question, Henry, because portfolios is a little different. Portfolios come with something called release provisions. Now, to make it as simple as possible, if you have 10 properties in a portfolio, each property is worth $100,000. Your portfolio is worth $1 million, right? 100,000 times 10. If you sell off one property, they charge, let me rephrase that. It's a principal pay down of 20%. So essentially, if you're selling one property, you're thinking, oh, I'm gonna have, I'm gonna have $900,000 value of a portfolio. It really is not 900,000 because you're paying 20% towards your principal balance. So it's really a 9 property portfolio at 880,000, call it. So release provisions is a big thing on that. If your end goal is to just hold, and you want to do that, I recommend it. There's prepayment penalties on DSCR loans, 3 years, 5 years, but Ohio's different. So Ohio is like a certain loan amount. I think it's like 113,000 and some change and less. There's no prepayment penalty, which is fantastic, but it does come with a little bit of an extra fee. It's like a premium from the lender's end. And then if you're $113,000 or above that $113,000 range, then it's a 5-year prepay at 1% across all 5 years. So if year 1 through 5, if you pay it off in one of those years, then it's a 1% termination fee or 1% prepayment penalty. And same thing goes for portfolios. Now, portfolios, I can do a 3-year prepay, I can do a 5-year prepay, I can do no prepay. It all really is just going to be dependent on how long you want to hold it. As a lender, I'm trained to say 5 years is 5 is the magic number, right? 5-year prepayment penalty, 5-year hold your properties. But as a normal, just bystander, um, the difference between the 5-year and the 3-year rate wise is like maybe 15 bips, 15 basis points. So 0.15%. If you're looking at that for cost numbers, it's maybe like $50 a month. Not really worth it to extend an extra 2 years and have to pay a higher premium within the 3, 4, 5 year. But if you guys have any portfolio questions, my number, my email is all there. Reach out to me. We can definitely run through it on more detail. I'm more than happy to do so.
And I've done multiple portfolio loans with Patrick, so he knows the process. We've done it together multiple times.
Yes.
So with that being said, Chuck, get us out of here. Patrick, thank you again. Chuck, you're muted.
No, I thought you were going to do the announcement, so I was going to
Yeah, I am.
allow you to do that. Patrick, listen, thank you very much for jumping on, taking time. I know you have some stuff going on in the background, but you killed it as always. A lot of really, really good information. And guys, the bottom line is this. When you are entering a deal, you want to get as much information as you can. And I will tell you that Patrick has been one of the most dedicated loan officers that we've worked with. And we have a select few, but the ease in which he does business, the communication, and the team that he has structured behind him has always been a personal favorite. So I'm looking forward to having you back in the mix with us, and we can't wait to have you out with the next Boots on the Ground. Again, contact information is there, and let's get ready to close out. Eric has some special announcements.
Yes,
and
yes,
then
yes,
we
yes,
will
yes.
we will get you guys back going with your weekend.
So, guys, as everyone knows, I've had actually a few investors in the program come to me about Birmingham. Everyone knows we have opened up Birmingham. We are there investing. Michael worked on that location herself. Miss Lori Dennison is there. Monica's there. They have purchased multiple properties there. I think Monica, right? Multiple properties there. Same with Lori. Monica, you have a couple there.
2, yeah.
Did we get tenants in there yet?
Yes.
Come on now. So I had a couple mentees reach out to me about going there. They only have one property. And since you guys have limited boots on the ground, they didn't want to go there and not be investing there and use one of their boots on the ground. So right now, everyone on this call, I'm gonna tell you, you can come to Birmingham if you have one property, and you can come to Birmingham and your boots on the ground will not be used against you. So you have a boots on the ground, get out of jail free card to come to Birmingham. Uh, we are definitely limited on mentees that are going out there. So we do block it off at about 8 to 10 mentees max per trip. We are gearing up for a trip. I think it's September or
September 13th through 15th.
September 13th through 15th. Put that on your calendars. We have 8 to 10. We are going. So first come, first serve. Your boots on the ground will not be used against you. And all it takes is you have one property already locked in, done, stabilized. You come out to Birmingham with us. So hopefully I'm making it easier for everybody. And let's get Birmingham rocking and rolling too. Let's get us 100 doors out there as well.
And one of the things about Birmingham, which is really cool, normally we have a dinner after, it's called the winner's dinner after our Win Blueprint Boots on the Ground in Cleveland. What we do in Alabama is we have a network meeting. So that's really cool. We put a networking event together. So on the last day, you go to an event and meet all the crew, all the lenders, all the agents, all the contractors, everybody's there. You're meeting them, we're eating, and we're having a panel, and also people from the community are coming down. from Meetup and other places to come see what we're doing there as well. So you get a chance to meet with contractors and other agents who may want to introduce themselves to you and things like that. So it's a really cool opportunity to have to go to a networking meeting at the same time.
Yes. Yep. So we'll start making announcements on that in the group page. Other than that, if you guys don't have any questions for us today,
I have a question.
Eric.
Come
So
on.
will we be putting it on the Birmingham group page or Cleveland?
We'll be putting it in the Cleveland because the people
Okay.
that are already in the Birmingham group, they're gonna come when they want to. Right? So yeah, we're gonna put it in the Cleveland group page so everyone in Cleveland everyone in Cleveland knows that we can come out to Birmingham too, and it's gonna be first come, first serve. And then it will fill up quickly. So don't waste time when you guys see that announcement.
Got
I
it.
think that Olga asked when the next Cleveland Boots is. I think it's in October. Is it in October?
Yeah, I
Yeah,
think we're
it's
looking.
October.
Yeah,
It's
we're
close
looking
to it's close to the end of October. I think, or close to Halloween, like the 24th. I think it's that weekend.
close to Halloween. We'll give you guys at least 45 days in advance notice.
Mhm.
At least.
But this is a great opportunity to meet all the new team there and everybody to get to know them and get to know the process for Alabama. The market's a little bit different. You guys get to see those areas. We have zip codes out there too that we work on. And so it's just a great opportunity to see a whole new market.
Yep. Options. You get options, and you
Right. I
just
bought my
see.
property out there for 60,000 and it just appraised at 175.
And when did you buy that property? How long ago?
I just bought it in October.
So almost a year. Okay.
Yep.
Yep.
Bought it
Great.
last October, priced at 175.
Monica, how's your experience out there so far? And we'll end with this because I know I don't want to keep people on too long.
It's slower. They move a little
They
slower
do
than
move slow.
but I have a really good property management company, and they have really been on top of handling things for me as far as like getting my tenant in. It's like they did everything and was done, and I didn't even have to be doing a lot of follow-ups with them.
I love that. Oh,
So yeah, that worked out well.
I love
Yeah,
that. All
yeah.
right. Okay. Lori,
We
how's
love
Lori?
responsiveness.
Uh-huh.
All right.
Yeah,
Lori, are you
we're
there?
definitely they're definitely slower, and even on Sundays, you know how we have the Sunday start date. We can't start till noon because of their church schedule.
Lori, how are you doing out there?
I'm doing good. My property is been rented for a few months now.
Okay.
Woo!
Nice.
I like that.
Contractor Carlos was awesome.
When
Just
I say
Phenomenal.
phenomenal, Carlos, he
Oh,
makes it look like a flip
I
rather
wish I
than
could
a rental.
clone him in every city I got.
Yes.
He's
My
awesome.
house looked like a flip. I was like, oh my gosh, I could sell this house.
Yeah, yours looked really nice.
Yeah.
But yeah,
All
no,
right.
it's been great.
Congratulations, Lori. Congratulations, Monica.
Congratulations.
Thank you, guys. I'm hopping off too, Ross. I'm coming right behind you. Hey, thank you, guys. We appreciate every single one of you for taking the time with us on this beautiful Saturday morning. I know you got other things to do that you could be doing, but you instead spend it with us, the Win Blueprint family. Over and out.
Thank you. Guys,
Thank
have a great day.